My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So this is the 5th episode of my Road to Financial Freedom series, and for those that aren't familiar, this is where I document the growth of a small portfolio that I started about 4 months ago, which I'm trying to grow as quickly as possible using the strategies that I talk about on this channel, like covered call writing and leaps option buying. So I started the account with a $5,000 deposit, and in addition to that, I'm also depositing $200 every single week. So the goal is to simulate the portfolio of someone working to achieve financial freedom starting from scratch, and to see how quickly it can actually be done. Now with that said, let's take a look at how the portfolio is doing so far. So looking at Robinhood, it closed today, March 31st, 2021, at a value of about $7,520. And to take a closer look, I'll go ahead and open up my spreadsheet here. So for those that haven't seen my recent videos, I did move my spreadsheet over to Google Sheets, and I recently launched a Patreon page where you can get access to it. So at the basic $2 tier, you get access to my spreadsheet template, and then if you go up to the $4 tier, you can also get live access to this Road to Financial Freedom portfolio spreadsheet, so you can see all of my holdings in real time. So of course, that info will all be linked below. So taking a look at my spreadsheet, that total portfolio value of $7,520 actually corresponds with the total loss right now of about $730, which in percentage terms is about 7.7%. And we can see if I scroll over to my net gain chart here, really over the last month and a half, this portfolio had been decreasing in value due to pretty much every tech stock in the market pulling back. And of course, ChargePoint, which is my biggest holding, had fallen in value by about 50%. But nothing has changed fundamentally with any of my companies, and they are starting to recover again, so I'm still happy with how the portfolio is doing despite all of that. And I'll get into that in more detail in just a bit here. And the main reason that I am still very happy with this portfolio is due to the premiums it brought in. Because of course, as a covered call writer, that is my main priority. And we can see that the first month I brought in $500, next month another $500, the next month $800, and in this most recent month of March, I brought in about $150 worth of premiums. So obviously that's lower than the previous months, and that's just because my stocks have fallen in value, and as I'm sure you know, it's harder to bring in high premiums when your stocks have fallen. But that $150 still represents about a 2% return compared to the total value of my portfolio. So that's definitely still pretty good. So the total premium I brought in throughout the life of this portfolio is just over $2,000. And I've never sold any stocks or options at a loss. So basically all of the losses I have in this portfolio are unrealized. And since I'm still confident in all of the stocks that I'm holding, it's really just a matter of waiting it out for those stocks to recover. And at that point, my portfolio should start to do really, really well. So in the meantime, let me show you what I've done so far. So the main move I've made since the last update is that I now own 200 shares of ChargePoint, and as of the last episode, I believe I owned about 120 or 130 shares. So basically what I did was when ChargePoint dropped all the way down to $20 per share, I started buying some more until I had 200 shares, and that brought my average purchase price of those 200 shares down to about $34. So what I then did was basically just split it out, so I said that I bought 100 shares at $43 and then my other 100 shares at $25. And by doing that, I could then comfortably sell covered calls at each of those strike prices without worrying about selling any of my shares at a loss. So you can see right now I have a 25 strike call sold against one set of my shares, and then I have a 40 strike call sold against the other set. So of course, if I get called out on the 40 strike call, I would take a bit of a loss relative to the price I bought them at. But as I discussed in last episode, since I've collected so much premium against those shares, my actual cost basis is quite a bit lower than 43, so I will be making a profit overall. Then other than that, I've just been selling calls on Zynga still, so that one has pulled back a little bit too, but it's still in a pretty good position overall. And as I've discussed in some of my videos, when I do see a pullback like this, I like to sell calls further out in time. So you can see that I currently have a call expiring April 23rd on Zynga, and then of course on ChargePoint, my calls expire April 16th and May 21st. Then in terms of my poor man's covered call on Apple, nothing has changed there either, so I'm still selling calls around the 137 or 138 strike price. Currently I've sold a call expiring April 9th at the 137 strike price. In terms of Leaps options, I'm still holding that original AMD Leaps, which obviously has fallen in value quite a bit, but I do expect AMD to recover pretty strongly once this pullback blows over. So I actually bought another Leaps option on AMD at a lower delta. I believe it was about a 20 delta when I bought it, and it doesn't expire until January 2023. So I have a lot of time for AMD to recover and be profitable on both of those Leaps options. So to be clear, AMD is a stock that I still really like. Then in terms of my long-term holds, I also bought one additional share of AMD to lower my cost basis there. And in order to make room to buy those 200 shares of ChargePoint, I actually sold off my share of Apple and Square, not because I no longer like the companies, but I was actually slightly down on those positions. So by taking a loss on those, I can actually write that off against my gains at the end of the year when it comes time to pay taxes. And I'm keeping track of the date that I sold each of those shares at because I have to wait 30 days to buy back into them due to something called the wash sale rule, basically to prevent people from buying stocks at a loss and then immediately buying back into them. So if you sell a stock at a loss, you have to wait 30 days before you can buy back into it, or else you won't be able to take advantage of the tax benefits. Now the other thing I'll mention is that in my updated spreadsheet, I do have a section for spreads and naked calls, although I haven't set any up in this portfolio yet, even though I think it is a great time in general to be setting those up given the current market conditions. And right now I don't really plan to set one up on this portfolio just because I would have to do it on a cheaper stock, and it just doesn't really work quite as well on cheaper, more volatile stocks. But if I do have some cash free up before the market really starts to recover, then I might consider adding one of those in there as well. Now the last thing I want to talk about is basically what I did on ChargePoint, where I averaged down on my position, and kind of talk about my thoughts on doing that in general and whether or not you should actually average down on your positions. Because on this channel, I've often talked about how I don't like to buy stocks as they're falling in value, especially for stocks that I'm trading, because once they start to fall, they tend to keep falling in value. And that is true, and honestly, this was kind of going against my own rules in that sense. But when it comes to these cheaper, more volatile stocks, which by the way, I'm still kind of learning how to deal with myself, because in my main portfolios, I usually trade the bigger, more solid Dow components or S&P components that I talk about in my other videos. But when it comes to these, I think it can sometimes make sense to average down as I did here. Because when you take a look at a company like ChargePoint, it's still a very solid company with consistently increasing revenue, and it has a very positive outlook for the future given the accelerated growth of electric vehicles. And since this stock fell over 50% in value from its peak, it just seemed like too good of an opportunity to pass up. And since this portfolio is pretty small, I figured now is as good a time as any to sort of take that risk. Plus, it allowed me to split out my shares as I talked about earlier, so I could bring in more covered call income that way. But when it comes to the bigger, more established companies like Apple, Microsoft, even PayPal and Square, I usually wouldn't average down on those positions until I see them start to show a pretty strong recovery. So for example, with PayPal, it got up to over $300, and then during this pullback, pulled down to almost $200. So I wouldn't have bought it on the way down, at least not to sell covered calls on, and right now I would still even be hesitant to buy back in. But once I start to see a really strong recovery, maybe up about 5 or 10%, then I would feel comfortable buying back into it to sell covered calls on. So of course, there's always exceptions to these rules. And again, I think if you are going to average down on positions, it should be on these cheaper, maybe a little bit more speculative stocks, as long as they still have solid fundamentals. But you certainly shouldn't be averaging down on cheaper stocks that don't have solid fundamentals, because those are the types of stocks that can basically fall to zero or at least close to it. So now if you missed my last video on how I like to set up my bear call spreads and naked calls, be sure to click that video in the bottom right corner of the screen. So thanks for watching, and I'll talk to you all in the next one.